Welcome to our deep dive into profitability ratios, essential tools for evaluating a company's ability to generate earnings relative to its revenue, assets, or equity. In this video, we'll break down the most important profitability ratios, explain how they're calculated, and show you why they matter for investors, managers, and anyone interested in business performance. Whether you're a student, a business owner, or just curious about financial analysis, understanding these ratios will give you a clearer picture of what drives a company's success. Let's start by exploring what profitability ratios are and why they're so crucial in financial analysis. Profitability ratios are financial metrics used to assess a business's ability to generate profit compared to its expenses and other costs. These ratios help stakeholders understand how efficiently a company is operating and whether it's making the most of its resources. By analyzing profitability ratios, investors and managers can identify strengths and weaknesses in a company's financial structure. These ratios are often compared across companies in the same industry to gauge competitive performance. Now let's look at the main types of profitability ratios and how they are used in practice. Gross profit margin is one of the most commonly used profitability ratios. It measures the percentage of revenue that exceeds the cost of goods sold, COGS. In other words, it shows how much money a company retains from sales after covering the direct costs of producing its goods or services. A higher gross profit margin indicates that a company is efficiently managing its production costs. This ratio is especially useful for comparing companies within the same industry, as it highlights operational efficiency and pricing strategies. Calculate the gross profit margin, subtract the cost of goods sold from total revenue, then divide that number by total revenue. Multiply the result by 100 to get a percentage. For example, if a company has $1 million in revenue and $600,000 in COGS, the gross profit is $400,000. Divide $400,000 by $1 million, and you get 0.4 or 40%. This means the company retains 40 cents of every dollar in sales after covering production costs. Gross profit margin is a key indicator of a company's core profitability, before accounting for other expenses like administration, marketing, or taxes. It helps businesses set pricing strategies and control production costs. Investors look at the ratio to assess whether a company can sustain its operations and remain competitive. A declining gross profit margin may signal rising costs or pricing pressures, while a stable or increasing margin suggests effective cost management. Next, let's discuss the operating profit margin. This ratio measures the proportion of revenue left after covering both the cost of goods sold and operating expenses, such as salaries, rent, and utilities. Operating profit margin provides insight into a company's ability to manage its core business operations efficiently. A higher operating margin means the company is keeping more profit from each dollar of sales after paying for day-to-day expenses. Calculate the operating profit margin, subtract both the cost of goods sold and operating expenses from total revenue. Then divide the result by total revenue and multiply by 100 to get a percentage. For example, if a company has $1 million in revenue, $600,000 in COGS, and $200,000 in operating expenses, the operating profit is $200,000. Divide $200,000 by $1 million to get 0.2 or 20%. This means the company keeps 20 cents of every dollar in sales after covering production and operating costs. Operating profit margin is crucial for understanding how well a company controls its operating costs. It reflects the efficiency of management and the effectiveness of business strategies. Investors and analysts use the ratio to compare companies within the same industry and to track a company's performance over time. A rising operating margin can indicate improved cost control or increased sales, while a declining margin may point to inefficiencies or increased competition. Net profit margin is perhaps the most comprehensive profitability ratio. It measures the percentage of revenue that remains as profit after all expenses, including operating costs, interest, and taxes, have been deducted. This ratio gives a complete picture of a company's profitability and is often used by investors to assess overall financial health. A higher net profit margin indicates better cost management and stronger profitability. Calculate the net profit margin, subtract all expenses, including COGS, operating expenses, interest, and taxes from total revenue. Divide the resulting net profit by total revenue and multiply by 100 to get a percentage. For example, if a company has $1 million in revenue and $900,000 in total expenses, the net profit is $100,000. Divide $100,000 by $1 million to get 0.1 or 10%. This means the company keeps 10 cents of every dollar in sales as profit. A profit margin is a vital indicator of a company's overall profitability and financial health. It shows how much profit a company generates from its total revenue after all expenses are paid. Investors use this ratio to compare companies across different industries and to evaluate management's effectiveness. A consistently high net profit margin suggests strong business fundamentals, while a declining margin may signal trouble ahead. Return on assets, or ROA, measures how efficiently a company uses its assets to generate profit. This ratio is calculated by dividing net income by total assets. ROA is particularly useful for comparing companies in asset-heavy industries, such as manufacturing or utilities. A higher ROA indicates that a company is using its assets effectively to produce earnings, while a lower ROA may suggest inefficiency or underutilization of resources. Calculate ROA, simply divide net income by total assets and multiply by 100 to get a percentage. For example, if a company has $100,000 in net income and $1 million in assets, the ROA is 10%. This means the company generates 10 cents of profit for every dollar of assets it owns. ROA helps investors understand how well a company is using its resources to generate earnings. ROA is a key indicator of management's ability to turn assets into profit. It is especially important in industries where large investments in assets are required. A higher ROA means the company is making good use of its investments, while a lower ROA may indicate inefficiencies or excess capacity. Comparing ROA across similar companies can reveal which firms are more effective at generating returns from their assets. Return on equity, or ROE, measures a company's profitability in relation to shareholders' equity. It shows how effectively management is using shareholders' funds to generate profit. ROE is calculated by dividing net income by average shareholders' equity. This ratio is a favorite among investors because it highlights how well a company is rewarding its owners for their investment. Calculate ROE, divide net income by average shareholders' equity and multiply by 100 to get a percentage. For example, if a company has $100,000 in net income and $500,000 in average equity, the ROE is 20%. This means the company generates 20 cents of profit for every dollar invested by shareholders. ROE is a powerful tool for comparing the profitability of companies within the same industry. ROE is a critical measure for investors because it indicates how well a company is using its equity base to generate profits. A consistently high ROE suggests that management is effective at deploying capital, while a low or declining ROE may signal problems with profitability or capital allocation. Comparing ROE across companies helps investors identify the most efficient and profitable firms. Return on investment, or ROI, is a widely used profitability ratio that measures the gain or loss generated on an investment relative to its cost. ROI is calculated by dividing the net profit from an investment by the initial cost of the investment. This ratio is useful for evaluating the efficiency of different investments and for comparing the profitability of various projects or business ventures. Calculate ROI, subtract the initial investment cost from the final value of the investment to get the net profit. Then divide the net profit by the initial investment cost and multiply by 100 to get a percentage. For example, if you invest $10,000 and earn $12,000, your net profit is $2,000. Divide $2,000 by $10,000 to get 0.2, or 20%. This means your investment returned 20% profit. ROI is a versatile ratio used by businesses and investors to assess the profitability of investments, projects, or marketing campaigns. It helps decision makers allocate resources to the most profitable opportunities. A higher ROI indicates a more profitable investment, while a lower ROI may suggest the need for improvement or reconsideration. ROI can be applied to almost any investment scenario, making it a valuable tool for financial analysis. Earnings per share, or EPS, is a profitability ratio that measures the portion of a company's profit allocated to each outstanding share of common stock. EPS is calculated by dividing net income minus preferred dividends by the average number of outstanding shares. This ratio is important for investors because it shows how much profit is available to each shareholder and is often used to compare the profitability of different companies. Calculate EPS, subtract preferred dividends from net income, then divide by the average number of outstanding shares. For example, if a company has $100,000 in net income, pays $10,000 in preferred dividends, and has 18,000 shares outstanding, EPS is $100,000 $10,000, slash 18,000 equals $5. EPS helps investors understand how much profit they are entitled to per share they own. EPS is a key metric for investors when making buy or sell decisions. A rising EPS often signals growing profitability, which can attract more investors and drive up the stock price. Conversely, a declining EPS may indicate trouble ahead. EPS is also used in calculating the price-to-earnings (PE) ratio, another important valuation metric. Investors should always consider EPS trends alongside other financial indicators. It's important to distinguish profitability ratios from liquidity ratios. While profitability ratios focus on a company's ability to generate earnings, liquidity ratios measure its ability to meet short-term obligations. Both are essential for a comprehensive financial analysis, but they serve different purposes. Understanding the difference helps investors and managers make better decisions about a company's financial health. Efficiency ratios like asset turnover or inventory turnover measure how well a company uses its assets and resources. In contrast, profitability ratios focus on how much profit is generated from those resources. Both types of ratios are important for understanding a company's overall performance, but they highlight different aspects of financial health. Using them together provides a more complete picture. Profitability ratios are most meaningful when compared to industry benchmarks. Different industries have different average margins and returns, so it's important to compare a company's ratios to those of its peers. This helps identify whether a company is outperforming or underperforming its competitors. Industry benchmarks provide valuable context for interpreting profitability ratios. Analyzing trends in profitability ratios over time can reveal important insights about a company's performance. Rising ratios may indicate improving efficiency or successful business strategies, while declining ratios could signal problems that need attention. Tracking these trends helps managers and investors make informed decisions and anticipate future challenges or opportunities. While profitability ratios are powerful tools, they do have limitations. They rely on accurate financial statements and can be affected by accounting policies or one-time events. Ratios alone may not capture the full picture of a company's health, so it's important to use them alongside other financial metrics in qualitative analysis. Always consider the broader context when interpreting profitability ratios. Profitability ratios are calculated using data from a company's income statement and balance sheet. The income statement provides information on revenues, expenses, and net income, while the balance sheet shows assets and equity. Understanding how to extract and use this data is essential for accurate ratio analysis. Familiarity with financial statements is a key skill for anyone analyzing profitability. Profitability ratios are not just numbers, they reflect the effectiveness of a company's business strategy. High margins and returns often result from strong competitive positioning, efficient operations, and effective management. By analyzing these ratios, companies can identify areas for improvement and develop strategies to enhance profitability. Strategic decisions should always be informed by financial analysis. Profitability ratios are closely linked to shareholder value. Companies that consistently generate high profits are more likely to pay dividends, reinvest in growth, and increase their stock price. Investors use these ratios to identify companies that can deliver long-term value. Ultimately, strong profitability is a key driver of shareholder wealth. Profitability ratios are just as important for small businesses as they are for large corporations. Small business owners can use these ratios to monitor performance, set prices, and control costs. By regularly tracking profitability ratios, small businesses can make informed decisions and improve their chances of long-term success. Startups often face unique challenges when it comes to profitability. Early-stage companies may have low or negative profitability ratios as they invest heavily in growth. However, tracking these ratios over time helps startups identify when they are approaching profitability and guides strategic decisions. Investors also look at these trends to assess a startup's potential. Effective cost control is essential for maintaining strong profitability ratios. Companies that manage their expenses well are more likely to achieve higher margins and returns. Regular analysis of profitability ratios can highlight areas where costs are rising and prompt corrective action. Cost control is a continuous process that supports long-term profitability. Pricing strategies have a direct impact on profitability ratios. Companies that set prices too low may struggle to cover costs, while those that price too high risk losing customers. Analyzing profitability ratios helps businesses find the right balance between competitive pricing and healthy margins. Strategic pricing is key to sustainable profitability. Market conditions can influence profitability ratios. Economic downturns, increased competition, or changes in consumer demand can all impact a company's margins and returns. By monitoring profitability ratios, companies can adapt to changing market conditions and make informed decisions to protect their bottom line. Profitability ratios play a vital role in financial planning and forecasting. By analyzing past performance and projecting future ratios, companies can set realistic goals and develop strategies to achieve them. Financial planning based on profitability ratios helps ensure long-term growth and stability. Lenders and creditors often use profitability ratios to assess a company's creditworthiness. Strong profitability ratios indicate a company's ability to generate enough earnings to meet its debt obligations. This can lead to better loan terms and increased access to financing. Weak ratios, on the other hand, may raise concerns about a company's ability to repay its debts. Profitability ratios are key factors in business valuation. Buyers and investors look at these ratios to determine how much a company is worth. High profitability ratios can increase a company's valuation, while low ratios may decrease it. Accurate ratio analysis is essential for fair and informed business valuations. Companies with strong profitability ratios are more likely to pay dividends to shareholders. Profitability provides the financial foundation for regular dividend payments and can attract income-focused investors. Tracking these ratios helps investors identify companies with the potential for consistent dividend growth. High profitability ratios often signal strong growth potential. Companies that generate healthy profits can reinvest in new products, markets, or technologies. Investors look for firms with high margins and returns as indicators of future expansion and success. Profitability is a key driver of sustainable growth. Profitability ratios also play a role in risk management. Companies with strong profitability are better positioned to weather economic downturns or unexpected expenses. By regularly monitoring these ratios, businesses can identify risks early and take steps to mitigate them, ensuring long-term stability. Profitability ratios are often used to evaluate management performance. High margins and returns suggest effective leadership and sound decision-making. Boards of directors and shareholders use these ratios to assess whether management is delivering value and achieving business objectives. Strong profitability ratios can boost investor confidence and attract new capital. Investors are more likely to invest in companies that demonstrate consistent profitability and sound financial management. By maintaining healthy ratios, companies can enhance their reputation and access to funding. Summary: profitability ratios are essential tools for understanding companies' financial health and performance. By mastering these ratios, you can make better investment decisions, manage businesses more effectively, and identify opportunities for growth. Remember to use profitability ratios alongside other financial metrics and always consider the broader context. Thanks for joining us on this journey through profitability ratios, your key to unlocking business success.